So if you become an expert on a city, a town, an area, a gentrifying area, there will be opportunities.
Hello, everybody. It's Jake Stenziano, host of the Wheelbarrow Profits Podcast, here with my co-host, the multifamily mentor, the coach, chef, the father, six, the best-selling author, the G-Daddy, Gino Barrow. Gino, how's it going?
Mr. Stenziano, I'm doing good today. How you doing? A little samurai action this weekend, a little crossbow action this weekend. Had a good weekend. How you doing?
Always making it happen, big man. Today's guest is Taggart Birge. In 2008, Tag and his partner Andrew founded Birge Held. Over the past 12 years, the company has grown to a market value over $1.2 billion. Tag currently oversees development, underwriting, and investment business lines. So without further ado, Tag, welcome to the show.
Thank you. Great to be here.
So it's our pleasure to have you. I noticed that you got started out, it looks like, in real estate investing in 2008. You want to take us back there and just give us a little glimpse into what it was like starting when the world was collapsing?
Yeah. There was a lot of sleepless nights, as you can imagine, in 2008. I think the Dow had been cut about 75%. The banks were all rolling back, virtually impossible to get a loan. And Andrew Held and I, who I've known my partner since he was 8 years old, we were real estate lawyers together. And both of us had worked at other companies after leaving the practice of real estate law, commercial real estate development companies. Both those companies were on their knees. One filed for bankruptcy, one didn't. We weren't owners, we weren't principals. And we got together and said, now could be an amazing time, because we saw the valuations dipping to points that no one thought, we'd see in our lifetime. And as fate would have it, my brother's father-in-law, who's a mentor to me and Andrew, who's the largest affordable developer in the country, said, you guys are exactly right. Now is the time to get in this business. He'd been in the business for 30 years, the multifamily business, company called Pegcor. And he was our original equity partner and frankly, balance sheet, because he had a big balance sheet, big operation. In 2008, the banks were looking for every reason to say no. And so we needed that key capital partner starting out in 2008.
So what was the first deal look like? How big was it?
So our first deal was 13 units. Mm-hmm. We flew out to San Diego, California, where we ended up doing 5 deals. I remember when I came out to San Diego and we met with CBRE, and they had a 500-page book of distressed deals in the San Diego market. And Andrew and I looked at each other and said, man, we're going to have years of opportunity to pursue busted deals. And our then 60-year-old business partner, capital partner, said, San Diego will recover quickly. You guys have 12 to 16 months. And we laughed at him, and he ended up being right. And that deal that we did that was 13 units was a busted condo deal. And that's really where we started in California, was buying busted condo deals, going from 13 units all the way up to about 120 units, buying them 30, 40 cents on the dollar and converting them to market rate, kind of affordable workforce housing.
But Tag, why real estate? I mean, you're a lawyer. What really attracted you to real estate?
Well, I think, anybody who's entrepreneurial and practice real law for a while, practicing law is a great career, but it's pretty one-dimensional. And so I was seeing my clients who were creating projects that I was helping put together. I actually practiced real estate law for 8 years. I left the week after I made partner. And, I was basically transaction based. I'd work really hard. I'd collect my fee. They'd move on down the road, and then they were collecting rents, creating value, and I wasn't participating in that. So seeing what my clients were doing for 8 years really opened my eyes to the difference between kind of ordinary earned income and passive recurring income.
So what was the sentiment from your friends, coworkers, after you made partner, you leave a week later?
So most people thought I was crazy, including my dad. My dad was a partner in a law firm, and I worked hard and I built a good practice. Fortunately, my wife was supportive of it. My partners at the time, at the real estate law firm, thought I was insane. And why would I want to take on that risk, have no salary, or walk away from, kind of a sure thing, if you will. but obviously ended up being the best decision I ever made in my life.
So what do they say now? I mean, do they do deals with you now?
He employs them, Gino.
Yeah. Most of them tell me that they wish they'd made the same move in their early 30s, done something more entrepreneurial. I mean, practice law, great. It's a great career, but you have to track your time by the 6-minute interval. And a lot of those former partners have become LPs in my deals. And I have probably 5 to 10 former partners that I work with that, basically anything we put out, they participate at the 50 to 100,000 level. And that's allowed them to enjoy passive recurring income, not as much upside, but a lot less risk.
So Tag, it sounds like it's a soul sucking 6 minutes, right? That's the first thing. And the second thing is, I can tell you, I'm guaranteeing everyone on this call that everyone's thinking that they're saying to Tag, you were really lucky getting in 08. That was the luckiest thing in your life when, you know what? Sky's falling. You don't know what's happening next. You're jumping without a parachute and you're taking all that big risk. Looking back now, hindsight's 2020. What do you say to everybody that's, getting into this market now? Now is not the right time. Is it ever really the right time, Tag?
I think I have a lot of conversations with people who want to become entrepreneurs. If you make it as an entrepreneur, it is far more rewarding than working by the 6-minute interval or working for somebody else. But not everybody is wired for that, risk. But if you are wired for that, I would tell you that in real estate, I truly believe, unlike the stock market as much, that there's always inefficiencies. It's a less efficient market. So if you become an expert on a city, a town, an area, a gentrifying area, there will be opportunities there, particularly with interest rates at 300-year lows. I think the hardest thing is to make that first move. I actually started buying doubles in my mid-20s. So by the time I left the practice of law at 34, I'd done lots of deals on my own, and I had as many as 25 doubles. And so that kind of gave me a little bit more confidence, starting out. I mean, I remember my first year as a lawyer, I made $60,000 a year. And I got up to maybe 90. And by that time, the banks, because I had steady W-2 income and they liked the prestigious law firm that I worked for, were loaning me a lot of more money than I ever thought they should have. So inefficiencies in real estate.
So you talked about entrepreneurs being wired. Can you talk about that a little bit? What do you think you need to be as far as, I don't know about skill set, but mindset? What do you think really lends a person to become an entrepreneur, become successful being an entrepreneur?
I think you got to have a big burn, a big desire to work for yourself. I think you got to be able to see the forest through the trees. I have, there's a lot of folks that have higher IQs than I do, frankly, whether they be a lawyer or a doctor or accountant. But then a lot of them get so caught up in the minutia that they can't see the big market opportunities. They get tripped up by small details. So if you're going to be an entrepreneur and you want to be your own entrepreneur in your own company, being able to size up the market and then believing and having enough conviction that you've sized up the market accurately, to me, those are just two key attributes if you want to be an entrepreneur. And
in partnership, speak a little bit about your partnership. Was it easier for you? Could you see yourself doing this by yourself?
I've essentially always had partners on everything I've ever done. Starting out when I was 25 and I was buying doubles, I was doing them with buddies. I think, to me, partnership is like a marriage. You got to pick a good partner, someone who's ethical, who's going to do things right, who's going to have the same worldview. There's always going to be a little tug and pull, particularly when you bring, families into it or complicated deals. But, I've been very fortunate with my partners. Never had an issue, and always kind of see the big picture, and ultimately it's about what's doing right for your investors and for the project.
I love that. So you talk about starting out with doubles, right? Anyone listening on the podcast who wants to get into multifamily, what should they do? What are the next few tasks that they need to do to get into this business?
So I think doubles are a great place to start if you're a would-be real estate entrepreneur. I mean, what I always looked for was kind of simple math. Like if I was at 50% occupancy, could I cover my mortgage payment? That was always a great indicator that you were buying right. The doubles price a lot less efficient. Now, we're buying 900 unit deals when you compete against Starwood. So, I mean, when you have those kind of institutional partners chasing deals you're chasing, the cap rates get bid down.
Mm-hmm.
I think if you're buying doubles, you should be buying between a 7 to 9 going in cap rate, and you should be looking for deals where if you're 50% occupied, you can at least cover your mortgage.
Wow. So I got to ask this question. You've been doing this for, 15, 20 years now. What do you see the difference between the '08 recession pullback to what everyone's expecting now? Do you see the same thing happening back in '08 where cap rates are just going to go back up and rents are going to drop and all? Do you see that going into this next recession that we're having?
So in March, obviously a lot of sleepless nights when we were all trying to figure out bottom.
Mm-hmm.
I think the biggest difference between '08 and 2020, COVID-based recession, is how the banks are approaching it.
Mm-hmm.
So in '08, the banks were quick to look at debt service coverage ratios, loan to value covenants, and they were quick to pull liquidity back and foreclose on borrowers that were otherwise making payments.
Mm-hmm.
The Fed in 2020, I think, learned a lot, and the banks learned a lot. In 2008, what the banks figured out, if they were successful in foreclosing, then they were getting cents on the dollar. So why not let the operator hang on longer? Many of those assets recovered from '08 to 12 if they weren't foreclosed out.
Mm-hmm.
And so what I see in 2020 is just a tremendous amount of liquidity and Fed intervention telling banks that, hey, you don't need to reserve as aggressively against non-performing assets. Let's take a little time out, a little bit more practical approach.
Mm-hmm.
And then you throw on that the incredibly low interest rate environment and the search for yield. I think one of the biggest drivers of real estate in the next 5 years is going to be the fact that the 10-year treasury sits about 90 basis points today.
Mm-hmm.
And most people cannot survive on 90 basis points or 50 basis points from the bank. So alternative investing in real estate is going to have its day.
So looking forward, what markets are you excited about? Because it sounds like you're pretty much nationwide. I'm not a big fan of California right now, but if you bought back in '08 and '09, you're probably going, yeah, I probably bought it like 150 a door. Now they're probably like 400 a door. So what markets are you really excited about now going forward?
So we would not touch California. We probably wouldn't touch New York. States where there's a big regulatory environment, high income taxes, maybe hostile to capital, where they have rolling eviction moratoriums, very dense urban environments, struggle from COVID and cap rates in the 3s. Those are not where we would be super excited. Now, having said that, there might be urban opportunities that come up, in New York or LA or San Francisco, that because rents are, falling by 30, 40%. So there might be some distressed opportunities that rise to the forefront. But as a general rule, other than distressed opportunistic, the macro trends in those environments are not what we're excited about. Probably where we're looking for cities and areas that are going to do well post-COVID.
Mm-hmm.
We started in the Midwest. We continue to believe in the Midwest. We see more capital coming from the coast to our kind of B workforce investment.
Mm-hmm.
These that we've been running for 9 years in the Midwest, basically getting yield. We love Colorado right now. We own the largest workforce housing site in Aspen. We have a deal in Glenwood Springs. We just bought a workforce housing deal near Beaver Creek, and we have 2 deals in Denver that we bought. And we think Denver, the mountains, with zooming, less dense, good regulatory environment. We think tier 1 folks might be relocating to some of those areas of the country, and we're excited about that.
I love that. What do you see COVID doing? I mean, everyone's blaming COVID for certain things. I think COVID just accelerated certain things, like people migrating out from urban to maybe more suburban. What other factors have you seen COVID accelerate or brought problems to your portfolio?
So of the, like 12,000 units that we have, 99% are suburban. Thank goodness. We have maybe 300 units in an urban environment, and that's in Indianapolis.
Mm-hmm.
And we're seeing, like most tier 1 or tier 2 cities, we're seeing falling renewal rates. We're seeing increased crime. We're seeing downward pressure on rents. And the big crystal ball is what will happen, this time next year when the vaccine is in place, and maybe those sports events and the venues open up back downtown, and what happens to the office market.
Mm-hmm.
The big question for me is the office market doesn't fill back up, will those millennials come back downtown? I would rather be invested in the suburbs because of the uncertainty. No one knows the answer to that question, what's going to happen over the next 2 to 3 years in these densely populated urban areas. But I do think suburban apartments that are affordable, you're going to need more affordable housing coming out of COVID because so many people have been knocked down a peg. And I think suburban workforce housing is going to be very strong next year.
So do you have any thoughts or any ideas on building? I mean, because if you can find land out in the suburbs and you can build what Chris Porter calls the suburban, where you have the suburban urban kind of feel for those millennials, where they feel like they're in a city-like atmosphere. And seems like the Southeast, Jake likes to call it the SEC, the Southeast Conference, cities like Nashville, Charlotte, where they have more land. You can't do this up in the Northeast because there's no land there. But do you think that's going to become prevalent also?
I think it could become very prevalent. I mean, it's all about supply. I mean, if you look at most tier 2+ cities like a Charlotte, I mean, the amount of new units coming online is just somewhat shocking.
Yes.
And just take our best, suburb. We have 1,000 units coming online right now, where, most years we'd have a couple hundred, 200 or 300, and that's, north of Indianapolis. Denver has thousands of units coming online. And so I generally get nervous about the new build, because if you don't hit your rents, if you're wrong about the supply demand, and let's say you're off 25%, well, you're underwater with where the build yields are now with construction costs and labor costs. Most people are building to around a 6 to 6.5 development yield. And so that can go wrong quickly. We're taking less risk, in my opinion. What we like to do is come in and buy something at a 50% discount to replacement value, and then put $10,000 to $15,000 a door in there. And so we have more margin for error, if you will. We have a best-in-class B, and we've developed a very unique rapid rehab, where we can do occupied rehabs in a day, 3 to 5 a day occupied.
That's awesome. Are you afraid of some of these cities? Are you looking at the absorption / delivery? Because I know everyone's moving to Charlotte. You have a lot of corporate headquarters relocating to Charlotte. Do you look at that like in Denver and in Colorado? I'm assuming that the absorption is probably there because they're delivering them. Like I'm right, like I told you, in St. Augustine, Jacksonville, like you used to use the word shocking. I'm shocked at how quickly these things are going up. I was with Jake in Knoxville this weekend. I drove by and he's like, we're down in South Knoxville. He's like, that wasn't there 3 months ago. I mean, it's just amazing the amount of delivery coming on. But it appears that in these markets like Jacksonville, like in Knoxville, and probably Denver, do you see that the absorption is occurring in these markets right now?
I think the absorption is strong and it is good. But what I would tell you, in those highly efficient moving markets, take a Nashville, for example, where they built thousands and thousands of units. You can't be an overnight expert in those markets. So if you think you're a smart guy based in Detroit and you're going to dabble and go down to Nashville, there's people who have been watching that market for 10 years that know more than you know. And because of the amount of supply, if you miss your underwriting on your rents, you could get hit. I mean, generally what I see, you go to any city in America and there's a crane. Well, who is that crane for residentially for? It's for the 10% of America that has generally had a pretty good decade, but 80%, the largest curve in our country, has not had a great decade. And so, for us, we would rather cater to those folks who are making 40 to 60, who aren't getting the new product because the new product won't support rents that they can afford, versus the 10% of America where 95% plus of the new product has been built for the last 12 years. So we're in a different model. I'm not saying you can't do that successfully. There's guys who do it some merchant builders I know have done fabulous in the apartment space, but I think we're deeper into that cycle. And unless you're a real expert with some of the pressures that are going on, you might miss your rents. And if you miss your rents and interest rates rise, then you're in big trouble.
Tag, how do you become an expert in a certain market? Right? Because there's a lot of people in the New York markets, in the California markets, that want to go to other markets. How do you ultimately become that expert in the market?
So I'll give you a real life example from Birge Held. So we wanted to do deals in Colorado because, even before COVID, we thought it was a great demographic play, more reasonably priced, and a friendly regulatory environment. And we were looking at deals, and we couldn't get comfortable sitting in our corporate office, Andrew and I, in Indianapolis. And so what we found, we hired was a regional partner who participates in the deal with us. And he'd been in the market for 15 years. We'd known him, we'd known his reputation. And so for those dynamic markets that are moving quickly, that, you know, you really have to be an expert on because the margins are tighter because there's a lot of capital going there. I really think you need to have some boots on the ground that understand, you know, the difference between that corner and this corner, what the dynamics are in terms of demographics, what can be afforded and rents, and frankly, the relationships with the brokers and the credibility with the brokers, particularly because we're buying most of our product rather than building.
Love it. Let's take a stroll down memory lane. It's your first deal that you're raising capital for. Walk me through that and give us, the listeners, some tips on raising capital for their first and even second deal.
So I think Jack Ma said it recently. I was reading about him. He said, when you're starting a business, you'll call all your friends and family and they'll say no. And then you'll go 2 or 3 circles wider and you'll find investors that way. And then your friends and family will come back and say, well, why didn't I have that opportunity?
So true.
That was my experience in 2008. I mean, you had to have Teflon on to raise capital in 2008. I mean, for every 100 calls I made, and I was calling a lot of at that time I was 34, my dad was still practicing law. And so I was calling my dad's partners who had money that were in their 60s at that time. All of them said no. And so with hard work comes luck. And we ended up finding a pledge brother who had sold the business, who had a ton of liquidity, who we hadn't talked to in years. It was actually a fraternity brother. And he was our first 7-figure investor. But I mean, that was after hundreds of calls.
So talk to me about those calls. What is the 34-year-old lawyer looking to get into one of the worst real estate markets ever with no liquidity, very little experience? What does Tag say on that call to get us someone with a 7-figure net worth?
So what you really need to do is start building your pitch book, and your pitch book can't be a sales book. It needs to be an educational piece. Mm-hmm. And so what we started putting together was, hey, look at where all these things priced for years. And look at the construction cost. And what we really educated our folks on was, do you believe, our pitch would go something like this: do you believe something will ever get built again in California? Well, yes, of course something will get built in California again. Well, how about buying something that is 50% cheaper than what it would cost to build anything new? And look at the fact that I can rent to 80% of the people in San Diego who have an average area median income $55,000. It's affordable to them. So we focused in 2008. We built our pitch book around educating them on the discount to replacement value and how affordable our rents would be to 80%. And we've never really deviated from that. I mean, that's how we've raised about $450 million of equity from 2008 to 2020. Mm-hmm. And we've sold 21 deals. And we've had a 20 IRR on those deals. And our deal has pretty much been the same every time. We buy a deep discount to replacement value. We do a deep analysis on the demographics. We show where our rents will be and how they'll be affordable to the average tenant in the Midwest who makes $44,000 a year, which is our average tenant.
So everyone listen up. Jake, he is employing Oren Klaff's strategy of inception. He's making the person he's raising the capital from think as if it's their idea. Wow. It's great. Multifamily sounds great. Hey, where do I sign, right? But this takes a lot of work, everybody. He's creating what we call the credibility book. It's all about getting it out there. If Tag is investing in Denver, he needs to tell people why he's investing in Denver. He needs to talk about the demographics. He needs to talk about the job growth, the population growth, why he loves that market, the replacement, like he said. Make the investor think that it's their idea. You're not selling. People don't want to be sold. They want to buy, right, Tag? And that's the best way to do it. Do you use any other tips? I mean, do you use a website, any other strategies, anything else?
So we've upped our social media. We've developed a big Instagram presence, and we're working on getting followers. We're sending more videos out of what we're doing, drone videos, whether it be a rehab or a new build. We're doing more and more professional investor updates.
Mm-hmm.
So, like in the old days, I'd send an email and, maybe have some graphics. Now we have a marketing department and, colorful graphics and all these icons that, really, I think make a big difference in terms of how the data. And then the last thing that I tell you that's been very well received is we've leveraged Juniper Square. So any one of our investors can click on, it's like a Fidelity account, and they can click on through Juniper Square and see our monthly financials that we publish. They can get their K1s, their accountants love it. And now that we have over 1,600 investors, we used to have two people who would have to just, organize K1s for all these investments. And Juniper Square has helped us leverage and stay in better contact with our investor base.
That's awesome. How has your buying criteria or your real estate investing evolved from 2008, from buying singles and doubles and maybe some quads to buying 300 and 800 unit deals? What has been the big aha for you of this whole journey?
I think that the big aha for me from 2012 or 2008 to 2020 is the need for yield. The fact that folks are, if you're a high net worth person who has $3 to $5 million, which is our typical investor in our LP stack,
mm-hmm.
you weren't wired to retire on 1% treasuries
mm-hmm.
or 2% corporate bonds. I mean, that just doesn't produce enough income. And so we left back to California. So we left California in late 2010. Starwood came in, bought something that, basically cleared the market. It's like once Starwood came back in, it was like this validation.
Mm-hmm.
The game was on, and, all the big boys who were kind of messed up from 2008, they'd gotten reorganized, got their capital back together. And so then we went to Phoenix. We did an incredible deal in Phoenix where our investors got like a 40% IRR. And then the big efficient capital came back. And by 2012, we were done with the West because the cap rates and the yields weren't there. It was all about pro forma rent growth, which was not our investor base. And we went back to the Midwest. And the first deal we did in the Midwest, I'll never forget this. We bought Muncie, Indiana, which most of your investors won't know where that is, but Ball State is there. We bought it for a 12 cap, and we had 4%, 3.5% HUD loan on it. I mean, I always say that my grandmother could have run that project profitably. And so as we started getting more yield, our investors were just loving that. And, word of mouth spread, hey, I'm getting 8-9%. And we were sharing the benefits of depreciation. So it was like 11 or 12. And that's before we even started selling anything. And that ability to generate consistent growing returns, if you can figure out that capital is efficient, you'll be able to attract it. Even if you're sitting at home thinking there's no way I can do that, I guarantee you, if you can figure out how to produce yield for people, you will attract capital.
Last question before you go to the personal growth. Give me a couple of tips of scaling from buying with your, buddies, doubles, to all the way up to owning, over 11,000 units right now.
So you can't outgrow your operations. You got to grow
mm-hmm.
a culture. We have spent the best money we've spent was focused on our culture and a consultant that we brought in. I mean, when you started de novo business, we now have 350 people. I mean, you get to figure out what your core values are.
Who'd you hire?
Craig Mara was our name, and he's got a book out that I'll get you guys a copy of. I mean, it's he's been fantastic for us, and I couldn't say enough. Without him, I mean, Andrew and I were two lawyers. As a lawyer, all you have to do is manage your client. And so the biggest journey for Andrew and I was learning how to be managers. I mean, when you have 350 people, if you're not running your company, it's particularly at this point, in the process where you have to have good operations because there's a lot of capital chasing large apartment deals, you're never going to be able to scale. So the operations, focusing on the right people, building your culture and your core values, if you want to scale. Not everybody wants to scale to the point that Andrew and I have. I mean, we could have had a nice living just having 100 doubles paid off over 10 years.
So I always say it to everybody, I've got 6 kids. You can have as many kids as you want. You have the child, you better take care of that kid. You better not move on to the next one until you take care of the one that you have. It's the same thing in investing in real estate. You can have 100 units, you can have 1,000 units. You need to take care of those. If you're not doing the job, you better hire proper third-party property management to do it. Don't be a deal junkie. Deal junkies are great, but they move on. But really, the 3-legged stool: buy right, manage right, and finance right. When you buy it right and you put great financing on it, you need that wheel, the manage right, baby. And don't forget about that, because that's where we get paid. So it's really important. Thanks for that advice. Awesome advice.
We call it our flywheel. We built a flywheel that's circular that shows how our projects start and end completion. And we brought all our management, to your point, in-house because we got disenchanted with third party. We figured to do it the way we want to do, we had to build our own management company.
The lawyer comes out in you, disenchanted. That word is very safe. They sucked. That's what they did. They were ripping you off, and they weren't doing the right job, which is okay. We could say that on the show, right, Jake?
I love it, man. Let's take a quick time out to hear from our sponsor.
Are you looking for ways to improve your life?
Here at Jake and Gino, our mission is to empower students through financial education and the vehicle of multifamily investing.
Yes, Jake. We agree that a person with financial intelligence can change the world for the better.
We've created our proprietary 3-step framework: buy right, manage right, and finance right, that we teach to our community. This framework, along with education, our one-on-one mentorship, on-site boot camps, and the amazing community, has propelled our students to massive success.
We've all been there. We've had so many students that have been able to shift their mindset, overcome limiting beliefs, and set a clear path to achieve their goals. Whether you're currently fixing and flipping, wholesaling, or buying single-family rentals, and you know that multifamily investing is the right vehicle for you, I encourage you to visit jakeandgino.com/apply to schedule your complimentary consultation with our team. And I want to let you know this isn't a high-pressure sales call. It's really just a discovery call to get to know each other better and see if we're a good fit for working together. And if for any reason we're not a good fit, our team has tons of resources we will share with you to help you along your journey.
If you're ready to stop spinning your wheels, go to jakeandgino.com/apply and schedule your call now. All right. So going back to 2008, we had a interesting call the other day with one of the coaches on the team, and he talked about there was the period where deals went from distressed to value add. Do you remember what point that was? Because you're talking about 2008, 2012, and the difference, but I think it's somewhere in there. But from your perspective, when did it go from distressed to value add, then light value add, and then all these different little buzzwords that the brokers throw out there?
I would say that 2012 is, from 8 to 12, there was pockets of distress. And from 12 on, we were done with distress and we were 100% focused on heavy value adds. And then we went from doing it on turn, where we'd not have the washer right, or we'd forget a screw here, or a countertop wouldn't show up, to our rapid rehab. Whereas if you go to YouTube Birge Held, you can see how we can rehab units in one day and everything's bought out and our labor's efficient. And then, they give us the keys in the morning, they come back and they have a new unit.
So you also have the operational value add, Jake. Don't forget that one. That one's that's another important one.
Absolutely.
Love the buzzwords. Personally, what is your best habit for success?
I think, if someone's to ask me why we're successful today, it's because we focus on training our people, treating our people well, building our culture. We're really focused on leveraging technology. The apartment industry really had not changed for the first, in the last 30 years, but I think you're going to see real innovation with the Internet of Things. It hasn't reached the B workforce piece yet. You see it in A urban, with Latch or with call centers, or leveraging remote leasing, which we did during COVID. But I think we're really on the verge of seeing technology being a critical part of operations that really no one was doing. Real estate was done exactly the same from 1980 to like 2015 in the multifamily industry. And I think you're going to see a big change here in the next 10 years.
Tag, what's it going to take? I mean, because, smart locks and all, they're still pretty expensive. Nest thermostats for the B space, when you're getting $750 or $800 for rent, it's a little bit hard. Even Amazon lockers, we've looked at a lot of that stuff. In the C space, it's still a little expensive for that. When do you see that breaking through?
Yeah, I think you're exactly right. Right now, it's too expensive, and we've had those conversations with the large vendors. Like, look, you've built a product that only works in the A. If you want to get scale, 80% of the product out there is not A. You need to figure out how to do this more efficiently. I think with 5G, with the entrepreneurial mindset of Americans, I think there will be companies that will get scale, that will get that product affordable. And I think right now they kind of have a one size fits all in terms of here's what we charge a month and here's the service. They got to have their A through C packages. And I think you'll see that in the next 24 months. I mean, we've been in conversations with some of the principals at Latch and said, look, this is what we need. Here's the Midwestern rents. Your product is great in New York City, but to work in Louisville, Lexington, Dayton, Ohio, here's where you got to be.
I agree 100%.
You were mentioning a book. You said Craig Morrow. What was that book?
So I'm gonna pull it up because I'm embarrassed that and we were actually featured in the book. So it's about in the moment conversations. And what our consultant tells us is that most groups that don't succeed, because everything really is a team of teams. If you think about what it takes to make an apartment successful, you got to have in the moment constructive conversations. And so what Craig has written is a book that called Cultures That Work. And in that book, it's really critical. If you're an asset management person and you're not happy with how your operations team is performing, most cultures, that asset management person will let it fester, will go 30 or 45 days, might have a water cooler conversation about how this operations person is falling down. And then that leads to kind of a breakdown of trust and communication. And what Craig has coached us to do is to have in the moment conversations where you call that person and you say, look, this is what I'm concerned about. This is what I'm not happy about. And you have that conversation, you clear the air. Everybody knows where you stand, and you try to develop concrete action items from those in the moment conversations. And it's amazing how powerful that is. And it's amazing how few organizations actually do that.
Any other book recommendations that you'd like to share with folks that have helped you along your journey?
Well, I love the book Rich Dad Poor Dad. I mean, when I was practicing law and I was getting frustrated, I was building my doubles, it was like a light bulb went on for me. I was like, I'm that guy who graduated Phi Beta Kappa and went to a fancy law school, and I'm trapped in this, career where it's one dimensional. And
you're speaking to me, man.
Exactly. Speaking to me. And I give that, we have summer intern class every year. And I give every one of those guys that book. I say, if you want a book that really speaks to how you build wealth in America, that's a good read. I haven't found anything better in 20 years. And I read a lot of financial literature.
Our focus, we can't agree with you more. We really look at people, systems, and culture. We're in the business, and as we're growing, that's really what it is working on the business so that, you touched on it before, that you're not outpacing yourself. You need to be able to eat what's on your plate before you continue to grow. Any other tips on scale? Because it's such an important, component to really developing the well-oiled machine. Anything else that you'd like to share?
I would say that my bet, if you're scaling an apartment company, is that probably the area that gets neglected the most, because I talked to a lot of other operators, is your accounting department. It's not real fun to have a bunch of accountants, but man, you have got to do good financial reporting. And if you're not investing in your accounting department with good software and top people, you will outgrow your accounting department, and you will produce reports that, as a principal, you may not be the best reports. They can be junk in, junk out. And so I would encourage anybody scaling up. I think you got to build your accounting department, and you got to build your own operations team. The third parties don't have confidence in. Most of them are just a volume business. They win 3 clients, they lose 1, they win 3, they lose 1, and they don't put the same care and thought and processes in place that it takes at this point in the cycle. If you're buying big apartment complexes, you're buying at a 5 cap or lower, and it's all about operations. It used to be in the old days, could you raise capital and how was your financing? Now, if you don't have the operations because the margins are thinner because there's more capital, you're going to get smoked.
So we, from the beginning started out just managing our own stuff. Any other like pros and cons? You seem obviously that you're a big proponent of managing in-house, having your own property management company. What types of things did you see that pushed you away from the third parties? And to just follow up with that, where do you recommend people starting out?
Well, I think you have to start out, as you're building. I mean, I used to manage my own stuff on the weekends too, in my 20s and into my 30s. And so you kind of understand, the issues that your property managers will grapple with. I mean, one of our core values is passion for people. And what I found is that the third parties maybe weren't as passionate about making sure that our tenants got what they need as timely as they needed. And when you have your own operations, you can build your own culture. And if you build your culture and you scale it, it gets down to the property management level, not just in your corporate office. And if you really care about your tenant base, you're going to get better tenants. You're going to retain tenants. I mean, retaining tenants is huge, particularly in the B space. And ultimately, you're going to drive better NOI than your competition. And I just don't think you can do that without your own culture and people that are basically living your core values every day.
Very well said. The care and the culture is not necessarily there, and that's not trickling down to the end user, and therefore customer service is lacking, and people just don't feel like anyone cares. Then that leads to retention. It's a death spiral.
Death spiral. I mean, think how much. I mean, it's at least $2,000 or $3,000 to turn every unit, let alone just the downtime that you have. I mean, the average turnover in the B world is 50% plus. And if you can just turn that 5 or 6 percentage points, that's huge money across 11,000 units.
Mm-hmm. Definitely. What project are you excited about right now?
I'm probably most excited right now about our workforce housing project in Aspen, Colorado. So we closed that March 18th of this year. And that was a pretty scary time to be closing on anything, because that's the day that the lockdown started in the United States. And shortly thereafter, they closed Aspen Mountain. But I love going to areas where there's tons more demand than supply. So Pitkin County right now, where Aspen is located, has 3,000 affordable units. They need 30,000 affordable units. We get 30 calls a day on our project. And right now our site is only 10% of the overall land. So we have 10 acres. And it would be developed the way someone might have developed in Dayton, Ohio, in the suburbs, because it was developed 25 years ago. So we have an opportunity to put a huge stamp on the town of Aspen, where we are working with them to get more affordable housing, do some market rate housing, densify it, and help solve that issue. Every time you open an Aspen newspaper, there's something about the affordability housing crisis, so we can help solve a piece of that.
Solving problems, Gino. That's what it's all about. What is the best way for folks to get a hold of you, the company they're interested in investing, et cetera?
So I would say, go to our website, send me an email. And if you send me an email, I'll send you out our overall returns. I shared earlier that we've sold 21 deals and gotten a 20 IRR on the 21 deals that we've sold. And I think we do it with a little bit less risk than new builds.
Very cool. Gino, you want to close this out?
Mr. Taggart Birge, whose great grandfather published Atlas Shrugged.
Woo!
Love the name Taggart. That's all I got to say. Great name. He came and became a lawyer. You can't win them all, right? Starts out in the legal department. And, as a lawyer, billing 6 minutes, it's got to be soul sucking. Looking around going, you know what? I'm not really creating wealth here. I'm creating wealth for everyone else except for myself. I graduated Phi Beta Kappa. I'm actually one of the smart guys. I'm not Jake and Gino. I'm really smart. I know what I'm doing here, but I'm not creating wealth. I pick up this Rich Dad, Poor Dad book, and, this is how you really create wealth. I've been reading for over 20 years, and this is the book. I mean, it's not rocket science here. So let me start buying some doubles with my buddies. And all of a sudden it starts making sense. I make partner. The week I make partner, I decide to, you know what, skip town and say goodbye to everyone. Everyone thinks I'm crazy. Everyone thinks I'm nuts. It's 2008. The world is falling. The economy is going into the toilet. And I decided to get into multifamily real estate, which is probably the most counterintuitive thing. I'm supposed to be a smart guy, and I'm doing the stupidest thing, and everyone's telling me I'm stupid. But you know what? I have conviction. I know what I want to do. So I start buying deals. I start raising capital. And 15 years later, I've got 11,000 units. I've sold 20 deals. I've got a 20 plus IRR. I'm crushing it. I love what I'm doing. I'm making an impact on the world. I want to really change multifamily. And you know what? I could have been comfortable with a couple hundred units, but I didn't want that. That's not what I wanted. I mean, really become focused and clear on what you want. And you know what? When I started out, I was managing people. I was managing, my clients. Now I've had the opportunity to actually grow an amazing organization that has over 300 individuals. And I can do that. And if I can do that, if Tag can do that, anybody can do it out there. Just having the focus and the vision out there. Don't get stuck and focused on just the money aspect of it. Focus on what you can do for your investors. Focus on what your goals are and what your vision is and the person you need to become to hit those goals.
Yeah, because here's the thing, right? Maybe when you're at 2,000 or 3,000 units, your life, right, from a financial aspect till now, I'm sure you have, more wealth, probably didn't change a whole lot. There's kind of this point where, all the things are nice, but you got a nice car, you got a nice house, you're able to do it. It's really about giving back and providing for society and just, doing great things and doing what you're passionate about. So that's the thing everyone has to keep in mind. You get to the point where the things are great, the toys are fun, but then it's about what am I going to give back? How am I going to set an example for my kids? And what mark am I going to leave, on this planet? So I think that's a very important thing to remember, folks. So.
Amen.
Well, Mr. Taggart, we appreciate your time. Gino, amazing job as always. And we'll see you next time, folks.
Thanks
Thanks.
everyone.